Welcome to this short executive knowledge lecture on topic 3 of paper 6 of the SFC licensing exams. This topic covers asset management regulations, and this is the big one at paper 6. You're going to see the most number of questions out of the 4 topics coming from topic 3. And there's a lot of technical material in it. So if you're hoping to pass paper 6, you really have to get topic 3 under control. And I'll take you through the material and I'll emphasize the important points to help you understand the material that you need to know to get through this exam. Now, as ever, a copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under paper 6 resources. And again, as ever, I recommend that you supplement these lectures with question practice. And we have over 230 questions for practice on the platform Examinator.online. Okay, what is going to be covered? I'm going to start off with looking at the Fund Manager Code of Conduct, and there will be a number of questions on this code, an important code for asset management. We will then consider the SFC Handbook for Unit Trusts and Mutual Funds and some of the general points that it raises. Now, in that handbook, we have the Code on Unit Trusts and Mutual Funds. And that we cover in section 3, section 4, looking at the approval process, authorization by the SFC of collective investment schemes, and the investment requirements, the requirement to diversify, etc., etc. And that's both for general schemes and specialized schemes. Section 5 looks at the major players in collective investment schemes, the management companies, trustees, custodians. Then section 6 is a code on open-ended fund companies. And I've already highlighted in topic 2 that open-ended fund companies are a relatively new addition to entities in Hong Kong. You register them through the SFC. They're vehicles for funds, and the paper 6 does address these. So the code on open-ended funds is important material. Real estate investment trusts, if it comes up, it'll be one question, and we will look at that material. Another area that is a favorite with the examiner these days, liquidity risk management, and the circular that has been published by the SFC, and we'll look at the important points in that. Mutual recognition of funds, it used to be just mainland China. Now there are a number of jurisdictions where there's mutual recognition, and we'll look at the requirements, and we'll finish off topic 3 with a consideration of mandatory provident fund products. Okay, the Fund Manager Code of Conduct. Well, this material at the top of page 3 under section 1.1 is important. It tells you who this code applies to. It applies to fund managers, but they split them up into 2 categories. Those that are involved with the management of collective investment schemes, whether or not the collective investment scheme is authorized by the SFC, and discretionary accounts. Now, usually discretionary accounts are for individuals or for a family, perhaps. Collective investment schemes are your mutual funds, your unit trusts. Difference between unauthorized and authorized collective investment scheme, and why is there the distinction? For a collective investment scheme to be offered to the investing public in Hong Kong, it must be authorized by the SFC. If it's not going to be offered to the investing public in Hong Kong, but is managed for private investors, professional investors, it does not have to be authorized, but the manager still has to comply with the Fund Manager Code of Conduct, etc. Okay, Fund Manager Code of Conduct, we're told further down section 1.1, 4 parts. We're going to go through these 4 parts now. Remember, if you breach any code, the issue is your fitness and properness and whether or not you can continue to hold your license. Again, Fund Manager Code of Conduct does not have legal force. It's not the laws of the land, they are SFC codes. So you're not committing a crime, you're not breaching. A breach is not an offence, and every now and then they will examine that point. Okay, where there is any inconsistency between the code of conduct and the fund manager code of conduct, the more stringent provision will apply. Okay, let's now look at part 1, which covers organization and management structure. These are reasonably general points, so please have a look at them. As I said, I'm going to pull out main learning points. Functional separation under part 1, that is just the insistence of having a barrier where there is confidential information, price-sensitive information, and that is the concept of a Chinese wall. Similarly, segregation of duties, where you are physically segregating certain activities. Front office activities should be segregated from back office, and we've listed what those are. Compliance and audit should be segregated from each other and all other functions, and the investment decision making very much should be segregated from the dealing function. Fund manager should avoid conflicts of interest, and if there is, the conflict should be disclosed to the clients. Risk management, yes, fund manager should quantify and identify and quantify risks which is exposed and have risk management procedures to minimize risk. Compliance, very similar to the code of conduct. You've got to comply with all the rules and regulations. And each fund manager should have a designated compliance officer reporting directly to senior management. 1.2.6 staff dealings. So with staff dealings under the Fund Manager Code of Conduct, we have the introduction of the concept of relevant persons. And that's what the code is targeted. Those are the persons the code is targeted at. Who are relevant persons? Directors or employees of a fund manager who make or participate in investment decisions, or who acquire information on investments or decisions before buying or selling the investments. In other words, they've got the inside information as to who's buying, who's selling, and what the investments are, whose functions relate to recommendations, any person who they control or influence. Okay, once we know who the relevant persons are, then we must be aware of the conditions that apply to them with regard to dealing. And please have a review of those points. Are they all going to be examined? No, they're not, but could they, some of them be examined? Yes. So you start to see, we've just started topic 3. There is a lot of detail. So we want to take on as much as we can and then do the questions to get up to speed with short-term memory. 1.2.7 benefits. Fund managers should not accept anything which is likely to cause a conflict of interest. Remember, this is under conflict of interest. Registers should be kept of gifts received, etc. Moving on to section 1.3, which is part 2 of the Fund Manager Code of Conduct. And we see that this part covers 3 areas: activities conducted for funds, custody of fund assets, and operations of fund. Now we start to see a distinction between collective investment scheme fund managers and discretionary account managers, because some of the provisions do not apply to discretionary account managers. Indeed, they have their own provisions that we will see at the end of this code. 1.3.1, activities that are conducted for funds. Well, this is for the collective investment schemes. There should be an investment mandate, and we have details of what is in that mandate. Best execution, fund managers should ensure orders funds are executed on best available terms. Insider dealing, not surprisingly, is prohibited. Order allocation, clients should get priority and be treated fairly. Fund portfolio turnover, no churning. And when we get to topic 4, we'll see that that is improper practice. Underwriting, can the fund managers underwrite? If it's permitted by the investment mandate, but any commissions, fees received must go to the fund account. IPOs, any stocks received on an IPO should be fairly and equitably allocated and no preferential allocations. Transactions with Connected persons should be arm's length, best execution, commission rates no higher, etc. And we've seen some of that in the Code of Conduct. Now, cross trades. Be aware, 3 types of cross trades. 2 of them are allowed, 1 is prohibited. Cross trades between clients, that's where buy for one client, selling from another client. A cross trades, are they allowed? Only if it's in the best interest of the clients. Trades are in line with the client's investment objectives. Trades are arm's length. Activities disclosed to the clients. Reasons are documented prior to executing clients. So there's a lot of administration, but yes, cross trades between clients are allowed. Cross trades between the house account and the client account, is that permitted? Yes, but you must have prior consent of the client. And then cross trades, the one that's not permitted, cross trades between staff accounts and clients, no, not allowed. Easy to write a question on cross trades, so be aware of those. House trades, where you are dealing for the house account, that's the proprietary trading account for your firm, then there are some conditions. You give priority to client orders, etc. Note the last point. House account is an account of the fund manager or its connected person over which you can exert control or influence, and that point has come up in a question. Page 8, continuing with the activities. Fund manager must have risk management. We've seen that before. If there is leverage, it must be disclosed. Securities lending. If you do use fund assets for lending purpose, repurchase or reverse repo, you must disclose details of the transaction to fund investors at least annually. Liquidity management, this is a big deal for collective investment schemes that are issued to the public, and we have a liquidity management circular from the SFC, and we'll cover that later in topic 3, and that's highly examinable. Compliance, if there's any non-compliance, you must report it to the SFC immediately. And any fund that is going to be terminated, you should take best interests of investors into account, and all relevant information should be disclosed to fund investors. Now we come to 1.3.2, the second part of this section, custody of fund assets. Who looks after the fund assets? Incorporated funds, that's mutual funds, companies should have a custodian to protect the fund assets. If it's a trust structure, trustee. This is absolutely central to paper 3. So incorporated, mutual funds, it is custodians. Otherwise, unit trusts have trust structures. You employ a trustee, and they have to safeguard the client assets. Who can be custodian? They list the 4 types: a registered trust company or AFR subsidiary of a licensed bank, or overseas bank or trust company with satisfactory supervision, or any other qualified institution with prior consent of the client. And then the third area, operations of the fund. Record keeping, yes, you should comply with the keeping of record rules. You should submit audited accounts. Annual audit reports should be made available to fund investors. This doesn't apply to discretionary account managers. And portfolio valuations by fund managers. All client assets should be regularly valued per the constitutive documents, and the base of valuation should be disclosed. Now, basis for valuation of client assets is something that can be examined, and yikes, look at the amount of detailed material. Be aware, listed shares should be valued on a consistent basis. Unlisted shares unquoted, cost adjusted with reference to some other people's views. Units of shares, collective investment should be valued at latest quoted prices. Value of list securities which are not actively traded or suspended from trading should be monitored. Actively seek independent price confirmations where appropriate, write down or write off the securities in the fund account. Decide whether to transfer securities to fund manager's own account and at what price. The net asset value calculation should be performed as per the constitutive documents. Internal records should be reconciled to third-party documentation at least monthly, and all interest in securities should be disclosed. There's 3 points at the bottom of page 10 there on side pockets. This is non-performing assets that can be sort of put into a side pocket so that it no longer affects the main fund in terms of valuation. So a fund manager may segregate illiquid or difficult to value assets into these side pockets. If an asset is moved into the side pocket, clear disclosure made to fund investors of the asset being moved, etc. And provisions regarding side pockets do not apply to discretionary account managers. This is for collective investment schemes. Now, I've made some detailed analysis of the basis for valuation. Be aware of it. Yes, some of these points can come up in a question, which makes it quite niggly.